welcome from wherever you're filing in. As you do join us, we'd love to hear whether you are eager to get back to live events and ready now, or whether you are interested in hybrid events, or whether you prefer these purely virtual Zoom events. And we also welcome you to introduce yourselves in the chat and share your names and LinkedIn's. And I see a bunch of you are already doing that, which is great. So with that, I'll welcome everyone to Venture Crush. I'm Ed Zimmerman. And on behalf of Lowenstein, we're really excited to have this Venture Crush FG program. And this is kind of an interesting one for a couple of reasons. We had set out to do product market fit, which I promise we will actually cover, but also two of our speakers today are part of the original founding crew of Venture Crush, the first 10 or so VCs in New York back in 2008 who were covering New York back in 2008, who raised their hands and said, we would be delighted to help and to show up regularly in New York and support community building there and support these programs, and having a cohort of predominantly New York companies at the time. And so we're really appreciative of those who kind of helped this part of the Venture Crush suite of programs launch, and that's Satya and Jeff. A little more about that as we do as we do bios and backgrounds. And I will start with Satya, and then Krista, Iris, and Jeff with a little bit of bio. Then Jeff will do a PowerPoint deck, and I'll do a little bit of housekeeping up front. So on the housekeeping part, we do have bios for our guests on an Airtable, and a link will be dropped. We use closed captioning as we always do. Definitely also wanted to mention that we recently welcomed Matt Vandergoot as another venture capital and emerging companies lawyer on our team. He's a partner in our DC office, and we are continuing to expand our footprint in DC under the leadership of our partner Zorema Yaramilo, who chairs that office for our firm. And our next Venture Crush is on June 7th. There is a time shift because one of our panelists, Salone Segal at Lumakai, is based in India. It's a fund with an India thesis that is local there. But we also have Catherine Boyle from, do they pronounce it Andreessen Horowitz? Andreessen, I don't know, from some firm, some Andreessen something. And Nikhil Sakdev at Insight Partners, and I do know how to pronounce A16Z, just for the record. So that's June 7th at 11:30 a.m. Eastern, rather than noon, because that extra half hour makes a bit of a difference. We had research on our amazing panelists today provided by colleagues at Lowenstein, who are lawyers in our group: Latoya Bethune, Rahul Devnani, Brittany Armstead, and Gwen Holst, and I appreciate that. And I also want to thank upfront our event team: Carrie Fisk, Katie Davey, Brittany Harlos, Angela Brondum, Ginny Wagner, Jenny Amador, and Betty King. And then the final bit of housekeeping is we are doing a Venture Crush LATAM. Our colleague Juan Soto and my co-founder and partner in First Close Partners, Carolina Horanca Mendoza, will be co-leading Venture Crush LATAM. The first installment will probably be in September, but we're definitely looking for people who are interested in learning more about that. So if you could just shoot us a note, you can email me, you can put something in the chat to Venture Crush, whatever you want, but let us know if that's of interest to you. All right, with that, thank you for bearing with us. And I said Satya would go first. And Satya, I'm a little confused about whether to call you a venture capitalist. at this point on a go forward basis. On a retrospective basis, there are lots of things I enjoy calling you, but venture capitalist is just one of them. On a go forward basis, can you tell us a little bit about what you do and why it's a little confusing as to whether you're a venture capitalist?
Sure. I guess if you're investing money in startups, then you're a venture capitalist. And so by that definition, we're still a venture capitalist, in addition to having a portfolio to manage. But yeah, so I'm general partner at a fund in San Francisco called Homebrew. We're a seed stage venture fund, have been around for the last 10 years, focused on the idea that technology, as it's getting cheaper, more flexible, more accessible, is democratizing access in powerful ways. And that's happening most profoundly in traditional industries like financial services, healthcare, education, et cetera. We historically have raised institutional capital for our funds and recently decided that we'd shift to a model that invests just our own personal capital. And as a result, we have a lot more flexibility in terms of how we work with founders. Our focus has always been working with a small number of founders and being very hands-on in terms of helping them build the companies that they envision. And we still have that focus, but have a lot more flexibility in terms of check size, ownership stage, and allows us to really focus on founders who we want to work with and who want to work with us. So we're still VCs, just with a different capital base.
And how different will it look from the founder perspective?
Not dramatically different. We still have a pretty, like I said, hands-on model with regular touch points. We still have our team in place to help support founders. The thing we really are doing is kind of removing the constraints that come along with a 10-year venture fund. And
you also wrote somewhere that Screen Door will not live on beyond the two of you, you and your partner Hunter. What? Sorry, not Screen Door.
You mean Homebrew?
Homebrew won't. Why is that? And then we can talk a little bit about Screen Door.
We started it because one, we wanted to work together. Again, we had worked together previously during our time at Google. Two, we really wanted to work closely with a small number of founders, and we started the firm really to work with founders, not actually to be investors. Investing was the outgrowth of wanting to work with founders at that time. Kind of capital was the cost of entry, so to speak. And three, we decided that with our strategy, which was focused on seed, the best way of executing that strategy was to be small and nimble from a fund perspective. And our belief was that as you raise more capital, you'd have to add more people and more infrastructure. And that wasn't something that we were necessarily excited to do. And so as a result, it's a two-person partnership. Will remain as such. And when one of us decides or both of us decide that isn't something we no longer want to do, then we'll wrap it up. But we've got some other projects involved with that we think will hopefully outlast us and have even more meaningful impact than Homebrew will.
And you, just before you were at Homebrew, you were at Twitter. Can you talk a little bit about what you did at Twitter? Because you've been a VC, you've been an operator, and then a VC again. You were an operator before that as well. Can you talk a little bit about what you did what you did at Twitter and how? Yeah, let's just talk about what you did at Twitter.
Yeah, I was VP of product at Twitter from about 70 employees to about 1,200 employees. I also ran the customer service or user services organization. So was there as we turned the company from a loose collection of people into a organized company and a business, and got it ready to go public. I left prior to the public offering, but got it ready to go public in 2013 or 2014, whenever it went public. And
my penultimate question for you now is, when you first joined Twitter, did Twitter have product market fit?
It had blinding product market fit. And as we'll talk about, I'm sure sometimes product market fit can cover a lot of other problems and issues. But Twitter had very obvious product market fit.
Awesome. All right. Tell us about Screen Door, and then we will go to Krista and Iris and Jeff.
Sure. Screen Door is a fund of funds that is focused on being anchor institutional capital for first-time underrepresented VCs who are raising their initial funds. The Screen Door is a volunteer effort of myself and 9 other GPs who have been in the seat for a while and have raised capital 3, 4, 5 times for different funds. Aside from myself and Hunter, all of the volunteer GPs are underrepresented themselves, so truly have been in the seat of the folks that we hope to back. We started the fund about a year ago now, have so far made commitments to 9 GPs, and hope to make 20 or so commitments out of this first fund. And then we've got ambitious plans for what Screen Door will become over the course of time. But we are supported on one side by traditional institutional LPs like Harvard and Princeton and Duke and Virginia and the rest. And on the other side, we're allocating capital to people who come from untraditional backgrounds, don't have traditional track records, but we think have the opportunity to generate outsized returns. And the thesis behind Screen Door is that the best way of changing the face of venture capital and of technology is by putting money in the hands of the people who allocate capital, because it's empirically true that they're most likely to back underrepresented founders who are more likely to hire underrepresented employees. And if and when those companies become successful, that capital, and importantly, that mentorship, will feed back into the ecosystem. That's a virtuous cycle that has proven true for the last half century in technology and venture capital, but that virtuous cycle has only been accessible to a small segment of the population. And so we're trying to recreate that virtuous cycle for folks who historically haven't had access to it.
Awesome. Love what you're doing with Screen Door. We're going to talk more about that. And thank you for sharing that, and thank you for doing it, and for your leadership, which is something that you have always been really vocal.
We're just following in your footsteps with First Close, Ed.
All right. Well, speaking of footsteps, Krista, you are doing amazing work at Citi. It is a relatively new effort. There's enormous potential, and you are also crisscrossing the globe a bit and doing lots of speaking and trying to help people figure out what's going on. So can you tell us a little bit about your background and about the impact that you're trying to have and lead at Citi?
I'm happy to tell you about our fund as well. Prior to coming over, I was an investment banker for 4 years after business school at JP Morgan and RBC. I did a very short stint in equity research and came over to be a venture capital investor. I initially joined the Impact Fund for 2 reasons: to do direct investments only within our Black Entrepreneurs Investment Initiative, and also to lead our fintech vertical. In early 2021, I realized that it made sense for us to invest in funds. So I launched our LP investing initiative and now lead all of our LP investments at the Citi Impact Fund. We're a $250 million fund, all balance sheet capital. We have 4 primary categories or pillars that we invest in. That's fintech or financial inclusion, the future of work, sustainability, and a category that we call physical and social infrastructure that includes healthcare, prop tech, and mobility as well. We're relatively stage agnostic after pre-seed, so we like to see product market fit before we actually move forward with an investment. And we invest up to $10 million. Currently have a portfolio of 30 companies and still actively investing.
And how big is the portfolio of funds?
Just 3 currently.
Okay. And what do you think the portfolio of companies will be? And is all the money from Citi, or do you have outside LPs as well?
We do not take outside LPs. So all of our capital is currently from Citi and will be from Citi for the foreseeable future.
Okay. And that fund number is going to grow up to from 3 to 20?
Potentially 6 by the end of the year. Fund investing is not a core part of our strategy. So we don't have plans to do kind of a 40 fund investment or focus. So it'll likely be up to 6 by the end of the year.
Great. And how was, and there's a little bit of commonality with Iris here, how was the transition from investment banking to venture, and then why venture at a place like Citi rather than a place like Homebrew, which I hear is not hiring?
That's the reason I'm not at Homebrew. I don't think Homebrew is hiring. So I'll start there. There were a few things. Citi gave me the opportunity to build something and really own a lot coming over from investment banking. So it worked out for me. I'll say the transition has been interesting. I'm probably a lot more on edge than some of my colleagues coming from investment banking. I would say outside of that, I think there are tools that are incredibly relevant. Valuation is incredibly important. I spend a lot of time in Excel. I spend a lot of time really looking at the fundamentals of the deals that we're doing. I spent a lot of time in tech. So I was in the tech team when I was in investment banking. So my focus hasn't differed too much coming over to venture. And I'll also say, going to business school at Columbia, I kind of always knew that I would eventually go into venture capital. I just didn't realize it would be so soon. So I suppose in some ways I'm lucky on that front. But you're right, I do have that commonality with Iris, who is also an investment banker prior to being a VC.
Yeah, and can you talk a little bit about your Black Women in Crypto initiative?
Oh, sure. This is kind of something that has nothing to do with Citi. So in January, I was invited to a crypto dinner in San Francisco. And at the time, I was the only Black woman there. And I thought that was odd, not just wrong, which it is, but also very odd because there are a lot of Black women in crypto at this point. So later on that night, I texted a group that I'm in called Black Women in Venture Capital just to see who else had been to such a dinner. No one had. I recruited 2 other female investors and hosted the first one at a place called The Battery in San Francisco. There was a great turnout, and we've started to do them in other cities as well. We have another one that'll be hosted next month in June at The Battery in San Francisco as well.
And how do people get in on that if they are Black women in crypto, and how into crypto do they have to be in order to be part of that?
You can be native or novice. Our focus is really about onboarding Black women into crypto, engaging people, helping them answer and ask questions, having open and honest conversation, connecting people with investment opportunities, with other people in the industry, with experts, with other like-minded people who want to share in conversation as well. People are welcome to reach out to me directly, whether on Twitter or on LinkedIn, or 2 of my colleagues, Neka Uzo Kibule or Lucy Fonseca. We're both on Twitter and LinkedIn, and happy to talk about the collective, which is the name of our group currently.
Awesome. Love that you're doing that. And your last question for you, you're from Michigan, you're from Detroit.
I was born in Detroit, Michigan.
And how has that shaped your investment thesis? And are we going to see more middle of the country deals from you at Citi, from your colleagues at Citi?
Absolutely. I'm certainly not the first person to say this. We've all heard the saying that talent is equally distributed, opportunity is not. Interestingly enough, living in Detroit, you kind of see the full spectrum of talent across a variety of people who are underrepresented. And you realize that talent is found in more places than Harvard, Stanford, Wharton, et cetera. So I would say for us, we're really focused on investing outside of New York, Silicon Valley, and Boston, and we'll likely continue to do that going forward.
You're not categorizing Boston as like a first tier city in any possible respect though, right? You're just avoiding.
Careful. You're giving me the mic in a few minutes.
We do.
Okay, well,
We do.
that you and I will have to differ on that one. I would say respectfully, but I respect you less than Boston, though. But it's not a thing. Okay, and on the fund investment thing, you're going to double your portfolio, and people should be reaching out to you if they are doing what?
Sure. If they're raising between a fund one and a fund four, right now we're focused on underrepresented fund managers. We're also focused on fund managers whose thesis has some overlap with ours. As a reminder, we're a double bottom line fund. We spend a lot of time in fintech. We spend a lot of time in sustainability. We spend a lot of time in healthcare. We spend a lot of time in the future of work. We'll caveat that by saying we do not currently have the capability to invest in fund managers who have never invested before, which has been a limitation for us, admittedly. With that in mind, one of the biggest items that I worked on this year is revising our guidelines to at least accommodate fund managers that at least have 2 years of investing experience. We also take meaningful operating experience into consideration as well, in addition to proof of concept funds.
Does that 2 years have to be at investing someone else's money, or can that 2 years be angel investing, strategic investing?
We're willing to consider angel and strategic investing as well.
Okay. Cool. All right. So I'm sure we will talk a little bit more about that as well, since there aren't too many panels that have 3 people who have senior leadership positions at funds that are investing in underrepresented managers right now. So we'll share that. And thank you again for joining us. So speaking of investment bankers turned VCs, Iris, welcome back. You want to tell us a bit about what you're doing at Floodgate? And it feels like in the past several years, your role there has changed. So maybe tell us what you have been doing and how your role has changed.
Yeah, happy to. As a former investment banker, much more used to having worked on large scale IPOs and M&A, people are often surprised to hear that I'm at a very narrowly defined seed and pre-seed fund. And so I joke, but there's an element of truth, as is true of a lot of jokes, that, I was in a state of an existential crisis because I'm very culturally aligned with founders at seed. I like being the player coach, going in when others don't yet believe and helping them figure out everything from hiring and setting up their company to actually scaling the businesses. But if I want to think about where I can add differentiated value, it's much more about the full life cycle of a company, including where and how they'll ultimately exit. And so I'm very fortunate in that at Floodgate, I have a role that's very bespoke to me, in that I source deals, but I'll actually hand them over to one of my 3 colleagues. And then I get very involved after the first check is written. And I decide how we're going to optimize the fund performance by doubling down on the companies that show the highest potential. And so I deploy our reserves almost as if it were an opportunity fund. And ideally, if I'm doing my job well, then 10% of our fund will go into the best performing company. And unlike our historic model, where we would write a check at pre-seed or seed and be okay getting diluted down over time, my hope is that we can actually be aggressive and greedy and continue building up our ownership, and thus have a decent amount when the company does actually exit.
And you also, coming from the world of banking, and you worked at bulge bracket banks, including half a dozen years at Goldman, don't big league bankers typically call like seed deals, kind of Mickey Mouse deals?
That would be a polite thing for them to say versus I'm sure with some of the other stuff that they say. But again, I think that I'm lucky in that the seed check, while every check is obviously very meaningful for us, the amount of capital I'm deploying, especially if I'm going into like a Series C, is larger than what we traditionally have written. And so this model kind of only works because the partnership honors it, meaning that, I'll just put it out there. People ask me all the time, are you really telling me you'll say no to Mike Maples for one of the companies he's invested in? And it only works because it's true. And Mike will actually honor it and say it was Iris's decision. And now I got to figure out how to get this company funded. Right. Because, and that is the point, is we have a fiduciary responsibility to our LPs. We can't have our follow-on investment decisions primarily be emotional decisions. And the risk, especially at seed, is we like to say, we take that leap of faith before anyone else believes. And so to some extent, you do become emotionally tied, not only because you believed in the founders at the very beginning, but there can be a cloudy period in which you risk having your vision for what the company could become overtake actually what the founder is pitching you on. And so you'll hear a lot of funds say every investment decision should be a brand new check. And that's more the model that we use, is that we don't want to have our sunk cost bias of, well, we're already in, nor do we want to believe that, we could save the company if they only had 6 more months of capital.
So Mike gets to blame you for not following on
Absolutely.
to his
Oh,
portfolio
yeah.
companies.
Yeah,
awesome.
that's why
What a
everyone still
great gig.
loves the first check writers.
That's a great job.
But again, as a former banker, I'm used to getting all the hate, so it's okay.
And speaking of Mickey Mouse deals, as a banker, you actually did Mickey Mouse
I
deals.
did. I did. I worked on
Can
Disney's
you
acquisition of
explain?
Pixar. Yeah, no, when it's funny to think back on it now, but Disney obviously has always been a huge and storied corporation. It was primarily the theme parks, and then the studio, and then a little bit of the ancillary business, meaning products. And then if you think about like the early 2000s or 2000 to 2010 is when they started buying franchises. And so I worked on the acquisition of Pixar. And it's funny to think that, for the first kind of 10 years post that acquisition, they used to only have one Pixar movie come out every year. And now obviously Disney's got more of a machine behind it. And then a couple of years after that acquisition, they bought the Marvel franchise as well.
Amazing. And because I knew that we would talk at least briefly about Disney, I am wearing my
Yes.
Disney supportive Say Gay shirt, and welcome Florida. I'm ready to vote on your secession from Union. Okay, so I also wanted to get a sense from you of, sorry about that, wanted to get a sense from you. There's something that you said in an interview in Forbes in 2018. My last question for you now. If you asked founders what it's like to work with me, they would say that I'm intense, but I operate with a high degree of integrity. I believe we should demand excellence of ourselves and each other, but we are also complex individuals, and our work selves only represent a portion of who we are as people. And I love that quote and the sentiment that you expressed. And so now that we're 4 years forward from that, how are you, in your role in venture, allowing for both the demanding of excellence from yourself and others while acknowledging the complexity of individuals, and that our work selves only represent a portion of who we are?
Yeah, and this is one of the things that I do think is special about being such an early stage investor, is that we are alongside our founders on their journey, oftentimes for 10 plus years. And so there are lots of founders where we backed them when they were coming out of college. And in the meantime, they've gotten married, they've had multiple children, right? Their lives continue to evolve as their businesses may or may not. And so I think that's something that, to be frank, and I'm sure the others on the panel have had a lot of these experiences, that when you are a board member at the earliest stages, the trust that you have to have of the founder, that you can be the person that they call more likely than not when things aren't going well versus when things are going well, right? And even that things aren't going well, that's true of the best performing companies, right? My colleague Mike was a seed or an angel investor in Twitter. Satya worked at Twitter, right? It's like everyone knows every company that goes on to be incredibly successful has at least 9 near-death experiences in the meantime. And just being able to always treat the founders with respect and empathy, and just know that we're all trying to get to a good outcome. And, one of the things that I really respect about the founders is, especially going into the type of market that we're in now, and I'm sure we'll address this, there's probably going to be a lot of rifts, right, and reductions, and coaching the founders about how to do that in a manner that hopefully sets up their former employees for success on a go-forward basis. That there's a lot of complex decisions that need to be made that may be tied to a business, but are first and foremost going to have a lot of human impact.
I love that you are always focusing on the human component of this stuff, even though I know that you are deadly with a spreadsheet. So thank you for bringing in that perspective. And speaking of focusing on the human component of this, Jeff, I know that you have been a prolific author. I've been wondering lately if you have made more investments than publications. And I believe that in the last 15 years, you may actually have published more between case studies, and please tell me it's only 2 books that you've published. But it's got to be almost a couple of dozen case studies at HBS and articles, not even counting the blog posts. Do you consider yourself more prolific as a publisher than as a published author than as an investor?
It's not even close. I'm way more prolific an investor.
Really? Okay. Do you enjoy the investing more than the writing? Because
I love all of it. I love the writing, the teaching, and the investing, which is why I can't seem to stop doing any of it. But one of the things I have the privilege of, and for the folks I know, there are a couple of my former students who are in this group. I spotted in the chat and on the roles. I have the privilege of investing in dozens and dozens of my former students. So that's sort of an unfair advantage I have as an investor, to be even more prolific than my writing.
And are most of those investments in your former students Flybridge investments or Jeff personal investments?
So we have Flybridge is a seed fund. So our fund is typically will lead seed investments, $1 to $3 million checks out of a $150 million fund. And we're investing out of our 6th fund right now. And then I created a pre-seed fund focused just on my students and out of the Harvard community, called the Graduate Syndicate, which I do with a handful of other HBS faculty members. And we're investing out of our 3rd vehicle from that. And we write 100 to 200K checks out of that vehicle. Got it.
Well, look, first of all, I'm glad that someone is supporting HBS grads, because I know how hard it is for them to get traction in the venture community.
Well, yes, you said underrepresented and underestimated, and compared to Columbia, it's really an issue.
Let's move on from that. So you announced 2 weeks ago that you had just closed on your newest set of funds. You crossed $1 billion in AUM, assets under management, for the whole Flybridge family, and you celebrated your 20th anniversary. Those are terrific milestones to have hit. Congrats. Did you get in just under the wire on closing funds? Like, did you? I'm not saying that you triggered the market shakeup, but do you feel like it was good that you did that in the late winter, early spring, as opposed to waiting to the summer?
Yeah, I mean, look, we're super fortunate to have a new fund during a time of a lot of turmoil, which I'm sure we'll talk more about as we get into it. So yeah, we feel very fortunate to have the support of our LP base and to have a new pool of capital to invest in out of.
And years ago, you co-founded Hack Diversity, which you've been actively involved in because you have at least 7 or 8 projects going at the same time. Can you talk a little bit about Hack Diversity and how that's going and how that has changed over time?
Yeah, so about 6 years ago, I co-founded Hackdiversity with Jody Rose, who at the time was the head of the New England Venture Capital Association, and who's a Black woman. And we had this blindingly obvious insight that everyone knows that tech is too homogenous, and that it was a very difficult path, in particular for Black and brown engineers, to get into our innovation economy companies. So we created this workforce development program that's a pipeline and a training program to bring Black and brown engineers out of community colleges, four-year universities, and boot camps, and provide them with a fantastic training program, mentorship, wraparound services to then pipeline them into paid internships at the top innovation companies. And we started in Boston. And now after 5 or 6 years, we have 130 fellows this year working at 30 companies like Wayfair and HubSpot and Rapid7 and some of the best innovation companies in Boston. And our fellows go from being minimum wage job workers to getting $100,000 a year job offers at the end of the program. It's been an extraordinary transformation for them, and we've had over 90% conversion into those opportunities. So we've got a group now of 400 fellows. We're creating a very powerful network effect in Boston, and now for the first time expanding outside of Boston to your hometown, as you know, Ed. We're coming to New York City. We're very excited about it.
So, and we appreciate the respect shown by, starting in the minor leagues, perfecting your game, and then moving up to the bigs here in New York. And so you're looking for companies, for startups and growth companies to partner with in New York so that they can tap into this extraordinary pipeline of talented and underrepresented folks.
Yeah.
And how should people access Jody, here in New York?
Yeah, shoot me an email, jeff@flybridge.com, and I'll put it in the chat, or you can put it in the chat, Ed, if you got hands-on keyboard. And I'd love to talk to people, in particular, portfolio companies or growth stage companies who already have a college internship program where we could slot our fellows into that program. So it's typically companies that are Series C, D, pre-IPO, or just post-IPO, 200 employees to 2,000 employees.
Awesome. Okay. So this is the only Venture Crush of the year in which we do a PowerPoint deck, and we don't do it, Jeff does it. And we found that it's really hard to talk about product market fit without creating a baseline from which we can all work. So this is kind of what you'd remember if you had taken Jeff's class 3 years ago or 6 years ago at HBS. And if you want to do the screen share and give us a couple of minutes on product market fit, and then we'll move into a more interactive conversation. But appreciate the opportunity to get to know a little bit more about each one of you separately.
Yeah, I'm excited to do this. It's a challenge for me to try to compress a very complex topic, which I can barely squeeze into a full semester, into 7 minutes and a handful of slides. And I'm also cognizant that the people on this panel have deep experience in this space as well. So what I'll do is try to just simply set the table. And as I said, compress what you normally might spend $80,000 for in a semester's worth of tuition at HBS to give you a little exposure to the world of product market fit and the science, which become really a science over the decades of that search for product market fit. And the concepts I'll cover are, and I'm going to go very fast, and we'll share these slides so people can have them and refer to them. But for the sake of time, I'll go very fast. The concepts I'm going to cover are the notion that a startup is an experimentation machine, that your objective isn't to grow out of the gate, but in the early stages to run a lot of experiments and to test and learn over the course of your journey, different aspects of the business model. I'm going to deconstruct product market fit, what it means, how to try to achieve it, make sure you're not wasting money, and then talk about a bunch of metrics that people use in the industry to determine whether they have it or not. So the first principle, this experimentation machine notion, which really, I would say, Steve Blank and Eric Ries really helped pioneer 10, 15 years ago, is this notion of taking a page from the scientific method from hundreds of years ago, which is to have the mindset of, you have a set of hypotheses. You believe you have a solution that you think is going to solve a big problem in the world. And rather than spend a ton of time and money and resources building that solution, you take the time to run a series of experiments to test those major hypotheses. That's really the essence of what this theory is all about. And the way I like to deconstruct it is to merge business model deconstruction theory, which has all these different elements of what consists of a business model, with startup experimentation and lean startup theory, to design a series of experiments that you run in the following sequence. First, focused on the value proposition. Do you have something that is actually of value to the customer, and being very precise about who your customer is? Then run go-to-market experiments to determine if you can get that product or service out into the hands of your target customer, your target segment, efficiently and effectively. And then run business model or profit formula experiments to see if you can deliver that product in a profitable fashion. And the challenge for founders is to design and run these experiments in this sequence, while at the same time building an organization that is effective at executing on these experiments. And so while you're doing these experiments and designing them as a founder, you want to make sure your team is building an experimentation capacity at your product organization, your growth function, which you need to stand up, your sales function, which you need to stand up from scratch, and if appropriate, your business development or partnership function. So that dual challenge that founders have, running experiments and building an organization that knows how to execute effectively experiments, is the challenge we'll get into and talk about. And the reason it's so challenging is you don't have all the time in the world, you don't have all the money in the world, and you don't have the perfect team necessarily on hand. So you are executing these experiments in the context of a number of constraints, which puts even more pressure on the design of the experiments, the sequencing of the experiments, and the execution of the experiments, because you want to pick the right experiments and you want to conduct them in the right order to be most efficient in the context of these constraints. And what that leads you to understand then is that the experiments that you decide, the selection of your tests, is the essence of strategy. Some of you may know this great book, The Art of Motorcycle Maintenance, which I reread last summer because I gave it to my son, and I read it when I was a teenager going out and traveling the world, and I gave it to him before his gap year because I wanted him to read it. And I reread it and I realized that there's an insight in that book that really speaks to this point, where the author describes, and it's a book a lot about philosophy and psychology, and the author describes the fact that the scientific method can be applied so broadly, and there's so many different experiments you can run, that although it gives you a methodology for execution, it doesn't give you a methodology for selection and strategy. And so what I would say to you is thinking strategically about designing and selecting your experiments is half the battle, and then executing those experiments is the other half. So the choices you make as to which experiments to run are very important strategic choices. Once you run those experiments and test those hypotheses, you can do that iteratively before you raise money, or with a small amount of pre-seed money before you raise seed money. You can even do this before you write a single line of code. We have many, many founders, even technical founders, who instinctively, although they want to put their hands on the keyboard and write lines of code, instead design wireframes, create prototypes, share paper-based prototypes with prospective customers and users, all for the sake of iterating, experimenting, and testing before they make what is the most expensive investment that you can make, which is actually writing code and building a product. And then if you think about, okay, stepping back, once you have the product in the wild and you're starting to iterate and see the product get exposed to the customers, how do you know you have product market fit? What are the key tests? I give you a number of them here. One is the 40% test, which Sean Ellis, a very prominent growth hacker, invented, which is that if you gave a product to folks and then you said to them, I'm going to take that product away, how unsatisfied, how disappointed would you be if I took that product away? And if over 40% of your users say they would be deeply dissatisfied, then you know you have product market fit. It's that distinction between a nice to have product, which people say, sure, if you give it to me, I'll use it, it's nice, but if you took it away, it doesn't really change my life, to a must-have product, which is really becomes essential to the workflow or to the life of an individual. So that's the 40% test. Another test is the Net Promoter Score, which is a measurement of whether people would recommend your product to other users and other consumers or other businesses. And if your Net Promoter Score, which there's a whole methodology on how you can measure that you can easily look up online, if you're higher than 40, ideally in the 50s, 60s or better, then you really are seeing signs of product market fit. Growth rate helps you. Unit economics, your lifetime value being more than 3 times greater than your customer acquisition cost, which is a whole methodology for calculating, which I can go into in more detail. Low churn, short sales cycles, but in essence, the most important metric is usage. Don't tell us how many downloads you have. Don't tell us how many user accounts have signed up for the product. What people want to see is usage. Month over month, looking at a cohort and seeing how they behave over time. Is usage growing? And are they climbing what Sarah Tavel from Benchmark refers to as the hierarchy of engagement? Are they engaged in using the product? They stick around and continue to use it even more and more, and then eventually even create this sort of viral loop where the actual usage of the product generates this self-perpetuating flywheel. If you can climb up that hierarchy of engagement, if you can hit these metrics, you have product market fit. If you don't, then you need to keep iterating. When Satya said earlier that Twitter had ridiculous product market fit, they had all of these elements flying, and I'm sure he'll talk about it. I wasn't on the inside, but just as an outsider, it was pretty obvious. The growth rate, the usage patterns, the positive flywheel, all with very little, if zero, sales and marketing investment. All of that was organic growth. So if you can have that product-led growth dimension, you really have achieved product market fit. So if you put it all together, and again, I'll share these out, but just to kind of synthesize all of it into one slide, you first focus on the value prop fit and all the various pieces of that phase. It's all about learning as opposed to growing. You worry about growing during the go-to-market fit phase, where you're worried about unit economics and getting those early adopters. And then later you worry about the business model, the profitability, and scaling your sales team. But don't focus on scale. Don't hire a ton of people until you really nail that initial piece, the value prop fit. So with that, I'm wrapped. I think I did it in roughly the time I promised. And as I said, we'll share the slides, lots more to share there. And I'm happy, of course, now having set the table, all of us can jump in and talk about this topic for more info.
That was great. Thank you. That was definitely within the time expectation. We appreciate it. And we should talk a little bit about why product market fit is so important in venture funding and in startups and how decisions are made around it. One of the most common ways that people communicate a decline to fund when you're a venture investor or an angel or family office or strategic is it's too early, or we love what you're doing, we'd like to see more traction. And that can mean lots of things, right? It can mean we are not interested at all under any circumstances. It can mean, exactly what it sounds like. We are actually interested, but we just want to see a little more traction, and anything else in between. But focusing for this question on Satya and Iris, how often are your respective funds investing pre-product market fit?
I would say the vast majority, if not 100% of the time, because to be frank, if there's product market fit, the size of the round that they're looking to get, as well as their valuation expectations, will eclipse what we can offer them. And so we like to say, at pre-seed and seed, we're willing to take on all the risk, but the hope would be we get paid for that risk, right? Which is why you see the multiples kind of come down with every stage that you invest in, because obviously the valuation is getting higher because it having been de-risked is then reflected in the valuation.
We're similar in that 100% of the time we're investing pre-product market fit. About 2/3 of the time we're investing pre-product. And I think part of that is because Hunter and I come from product backgrounds. So that's the type of risk we're most comfortable with. We tend not to take team risk. And we spend a lot of time on understanding the market opportunity, not necessarily that there's a multi-billion-dollar market today, but that there's a pain point that's felt broadly in the market and acutely, and that eventually you can extract some economic rent for addressing it. And so those are the two things we try to check the box on. And our firm belief is that most companies rarely end up where they start from a product perspective. But that journey to product market fit is one that we're very comfortable with and hopefully can be helpful with given our backgrounds.
And when you say 100% of the time, you both meant for your initial checks, because the number is way below 100 when we're talking about later checks.
Yeah, that would be the hope.
Okay. And Krista, for your later checks, not when you're cutting a seed check, how often is there product market fit?
100% of the time. I think one of the things that people don't necessarily understand about taking capital from a corporate VC versus a standalone VC is that we are far and away more risk averse than probably every other venture investor on this call. So we're in a highly regulated industry. We never actually do pre-seed, as I mentioned earlier, and we're not willing to invest in a company that is still trying to figure out PMF. So for us, even at the seed stage, we want to see very clear evidence that product market fit has been realized.
And how, other than the ways that Jeff outlined, what are some of the rubrics that you apply to ascertain whether the company has met your rigorous standard for risk-free venture capital deployment into post-product market fit companies?
Sure. We won't say risk-free, we'll say low risk, as highlighted by our actual risk team. So for us, we generally look for around, we do have a risk team that evaluates all of our deals. Generally, we look for at least around 1 million in ARR for LTM 12 months traction. We like to see low logo churn, low revenue churn, high revenue retention. We like to see a really strong team. So given that our team generally is light on operators, most of us are former bankers, we like to see people starting companies in industries that they know very well, primarily because that's not necessarily an area where we can add a lot of value. I'd also say we do our own research in terms of market sizing. So for us, we go through a decent amount of work to make sure that we've validated everything that the founders have shared with us during their pitches. And
I'm fascinated by the $1 million in ARR because there's in my mind, things like team and quantum of ARR are very different than product market fit. I'm not saying that there are not boxes you should check, but I'd be curious if Ira, Satya, Jeff, if you have a view on that threshold for ARR in particular.
Well, I would just say there are leading indicators and lagging indicators, and in many ways, ARR is a lagging indicator, and what that scale looks like is, eye of the beholder in terms of where they want to be on the risk curve, as Krista mentioned. Leading indicators are product usage. So when you see a product being used every day for hours and hours a day, that's a leading indicator that you're not going to see a lot of churn. And when you see this viral component begin to kick in, whether it's growth within an account or referrals in a B2C context outside of an account, like a chain reaction that you would see in a social network or a Slack or a Zoom, where people need to be a part of the product in order to communicate, again, then you're going to see this drive in usage and growth prior to really seeing the ARR kick in.
And so, Krista, just for clarity, are you folks using $1 million in ARR as a definitional lens, not necessarily for product market fit, but to just evaluate like the scale of the companies that are of interest to you?
Absolutely. So we're actually at a point now where we won't take a look at a company that hasn't reached that level of traction. So for us, that's one of the reasons why I led with that. Even if we see a company that has a great product, high usage, meets the threshold that Jeff just described, and hasn't reached that ARR threshold, it's not a company that we would move forward with given our risk appetite.
Okay. And so there is this chasm between what counts for purposes of seed and how you get to the other side for purposes of an A round, B round. Do we think that let's erase the last couple of months or rewind and go back to late last year, Q3, Q4 of last year? Does getting an A round mean that you've attained product market fit in venture generally? Is that what people were looking at late last year?
Yes, from our perspective, but I'll defer to the folks that have been doing this much longer than I.
I think the advice we would often give our portfolio company founders for us to be supportive of them going out and raising their A is that there has to be a playbook where it's not just founder-led sales, right? And not that they already have a head of sales in, but rather they've figured something out where now it's not that the founder is so compelling and an evangelist for the product, but someone else could actually come in and sell the product as well. I think that, to be frank, over the last 2 years, just because there was so much capital in the market and so much velocity in deals getting done, that a lot of companies were getting funded with a Series A in advance of the $1 million of ARR or evidence of product market fit, just because people were willing to go in and say, there's going to be a big company in this space, and I'm willing to kind of place a bet based on maybe the founder or early signs of product use.
And Satya, I love this concept of, for us to tell our founders, yes, we think that you're Series A ready and we want to, support this process. I like that rubric, and we see a lot of companies that have a very difficult time getting beyond. We have this amazing, visionary, charismatic founder. She can sell anything, but we can't get other people to close deals. That's an issue. How are you seeing whether that has changed, or has it changed from, is the line of where you need to be in product market fit as it correlates to your ability to get next round funding? Has that moved? Is that part of what happens in choppier markets?
Historically, it certainly happens in choppier markets. You have changes in what investors are willing to pay from a valuation perspective, and you have changes in their expectations of what a company has achieved with the capital that they've already raised. And I'd say it's almost always been true that to raise a Series A, for the vast majority of companies, you need to have product market fit. There are the exceptions that you hear about, who are the particularly pedigreed founders, or the blindingly attractive market opportunities that people will just throw money at. But for the most part, the vast majority of companies have needed to demonstrate product market fit. And then prior to the last couple of years, I'd say to raise a strong Series A, companies needed to not just demonstrate product market fit, but to Iris's point, needed to demonstrate kind of go-to-market fit as well, meaning that there was a repeatable, scalable go-to-market model that there were early signs of. And I think we're going to get back to that. It hasn't quite trickled down to the early stages of the market yet, but we're beginning to see signs of that. And so what that means for early stage founders is that whatever capital you raise at seed, you've got more to prove, which usually means that you need more time to prove it as well. And so being particularly diligent around your expenses and your team size during that seed phase is going to be more important than ever, because what you need to prove is probably return to norms relative to the last couple of years.
And there's a question from Cassidy Palladino in the chat that says, that asks kind of how do you explain the difference between traction metrics prior to product market fit that you would look for at seed versus pre-seed? I'm not entirely sure that I could articulate the difference between seed and pre-seed, other than people who raise pre-seed, maybe pre-product, pre-larger team, have better access to capital. But I'd love to hear a more sophisticated explanation of the difference, because I'm not sure that it's traction metric specific.
Yeah, from our standpoint, the way we think about investing, there's no difference. It really comes down to check size or round size is the delineation between pre-seed and seed. Because we tend to invest, as I said, pre-product and certainly pre-product market fit. I think for a lot of investors, though, pre-seed is the period where the company puts an early version of the product in market and has some hypotheses that they've tested. And seed is kind of scaling that MVP to a product that truly establishes product market fit and hopefully some go-to-market fit. But I think the pre-seed phase for a lot of investors is proving that they can deliver a product that has some signs of being valuable in the market, but not necessarily true product market fit. For us, there's no distinction other than round size and check size.
Oh, sorry, Iris, go ahead.
No worries. I would just echo what Satya said. It is much more these days a reflection of the round size, which obviously does tie to other kind of business factors. One of them being, are you at ideation phase? Is there no team? Is it really someone who has an idea and wants to run some experiments potentially out in the wild versus I have a team, we have a version of the product that we haven't necessarily made publicly available, but we think we're ready to, and now we want to have some guardrails put in place in addition to capital. But really it is about, there is still a ton of risk, and whether it's pre-seed or seed, it's probably more a reflection of how much is actually being raised.
And if I may, I'm going to throw a slide up if you'll allow me, Ed, because
Sure.
Iris used this language about founder selling and Satya used this language about go-to-market fit. And this, I think both of them are sort of talking about this idea of the sales learning curve, which the panelists are very, very familiar with, but maybe not everybody on the call is, which is this idea that in that pre-seed or seed stage, the founder is doing all the selling. And that's actually healthy because the founder should be in the market learning from the customers and the market discovery. That's part of the journey. So founder selling is actually desired in the earliest stages at the pre-seed seed stage. But once you begin to see those early signs of product market fit, that's when you raise that next round, call it the Series A, to invest in building the sales team, where the founder taps out in terms of their personal selling capacity. And you want to see some early signs that a sales team can be brought on board, where you do this expeditionary selling, where you're looking to learn about building the sales playbook, finding go-to-market fit. And then the Series B is all about scaling and building the machine so that you're doing this repeatable, highly scalable sales model. So that's just sort of a visual to talk about some of the concepts that people were just throwing around.
And the lean approach and constant iteration is great if you have a product or a service that you can actually move through kind of quickly. When you're looking at deep tech, for instance, when you're looking at something that is a really complex problem, how does that actually, how do you work that? Because it's really hard to get to product market fit without a lot of spend. A classic example from long ago, we would represent fabless semiconductor makers, 20 years ago, getting venture rounds. It was great because it would take 6 years and 5 rounds before you knew if the thing worked. There is no product market fit.
And so what I would say to that is oftentimes you'll see certain firms where they're flying a banner saying they're doing frontier tech, for example, and they tend to be larger funds, right? Because they realize you're probably not going to start off with, $500,000 pre-seed and go by drips and drabs, but that you're probably going to go straight to A and do a bigger round because just even the materials that you need and the capital investment is much more meaningful. But on that note, I also just wanted to point out that I think what both Satya and I were kind of circling around when we're talking about pre-seed versus seed, and the categorization being probably more a reflection of the check size versus necessarily, sequential advancement of the product, is one warning that we often give founders is, if you are raising a seed, but it's what's become affectionately known as a mango seed, you just have to be careful because the investors, when they're giving you that much money, they've made a bet on the business that you pitch them. Versus for those of us who focus purely on the earliest stages, the expectation is the companies are likely going to pivot. At Floodgate, I don't know if we should be saying this mostly with humility, but it's the reality. Our biggest outcomes have all been pivots, right? They're not even called the same name that we wired the check into, whether it's, Zimride and Lyft or Odeo into Twitter. And so it serves us well to do smaller checks, knowing that there's going to be experiments that are run, and the size of the check actually forces discipline on the founder to run multiple experiments without just going all in, trying to hack growth before there's even product market fit.
I just want to pause on that for a minute, because what you just said is your biggest outcomes, the investment thesis around the product and its market was almost completely wrong.
No, that's not at all what I said, right? Because actually the mental frameworks that we use are, it's about the founder and their insights,
right,
about inflection points that are coming, right? Like Zimride to Lyft is not a completely different industry. It was about carpooling, and that if you actually aren't the ones driving directly, then where you live is much less of a factor based on where you work.
So Odeo to Twitter, and there's a reason I'm drawing this out. It's not to criticize you, and I'm not saying that this is a Floodgate specific thing. This is a seed stage risk. And if you scroll back to Satya's comments from 15 minutes ago, he said, the product is, almost never where it started, right? And that's why you focus so much on teams. But Odeo to Twitter is a different thing. And so
it's communication, right? And the idea, again, is that, right, his prior company had been about blogging. And the thesis was anything where you make the ability to go one-to-many easier is something that he thought would catch like fire.
So if you have, go ahead, please, Jeff.
Yeah, I would just say what Iris is describing, which we've seen too, a couple of our biggest companies, MongoDB, started as 10gen, which was platform as a service, and turned out the database was the most valuable part of the platform. So they pivoted. FalconX, this prime brokerage crypto exchange trading platform, originally was going to be an exchange in India, and then was going to be an ICO merchant bank, and then became this prime brokerage for institutional investors. Like these iterations are a part of the product market fit journey, because as Iris said, we back at the pre-seed and seed stage, amazing founders with extraordinary earned insight into markets that we think are massive markets with huge waves, huge secular trends that provide massive tailwinds. And the iteration of who the customer is and what the value prop is, that's just part of the natural journey along that surfing those huge waves. And when they finally find it, that's when you feel great about where this company is going and what's coming ahead with the scaling challenges. But it's those iterations, that's super natural.
And this is part of where I'm trying to go with my comment kind of question, right? So Odeo to Twitter as an example, other things where it looks like a big pivot. If you are finding that product market fit is elusive and you have a better idea and you are more impassioned about that better idea, that is really freaking hard. And it's really hard because you've sold your seed investor or your pre-seed investor, and we now realize they might be the same thing, on this idea. But really your seed and pre-seed investor, if they're experienced, if they've been doing this for years, they understand that the thesis is probably you more than that the thesis is the market. And what I want to ask is, when you're in that space where product market fit is elusive and you're thinking, let's just toss this crap entirely and we should really be doing this, how do you deal with that, and how do you talk to your investors about that?
Ed, I'd say there's a slight nuance to what you just said, which is I think all of us are on the Zoom here are investing not in the idea, but are investing in the team and the insights that they have, right? So we found that pivots work, but pivots work when the team is pursuing a new product idea, but is still focused on the same user and based upon the same insights that they had about the problem that that user has. So I think it's very difficult to talk to any investor when you're, building a vertical SaaS company and you decide you want to go into crypto, right? Like that's a difficult conversation to have because that is not related to the insights in all likelihood that they invested behind. But I think it's fair to be upfront with investors about why you believe that you can't find product market fit with the original idea and why you decided that you want to pursue something else. Hopefully that's not a surprise to your investors. I think that's the most important thing is if you're doing a good job of updating your investors and having them involved throughout the process, then everybody should be on the same page that product market fit has been elusive and hopefully been having discussions about how to move forward. But that it can be challenging when you're pivoting that dramatically, right? When you're changing who you focus on as a user and the insights into something completely different. But as early stage investors, we know that happens. But we also know that when a shift that dramatic happens, it's more than likely to be unsuccessful.
That's great. And Iris, I think this goes back to your earlier comments where you're trying to build the relationship and build that trust where the founder can come to you and your team to talk about, here's what we're thinking about. We are in that valley. And I know we're going to talk about another valley shortly, but we are in that valley. We feel a little lost. And what are some things that you think you can do? And what are things that you've seen founders do to build that trust where they will be able to say to you? Because if the founder can't communicate suboptimal news to the investor, you've got a real problem.
Yeah. Well, so I would say one key attribute of founders who are trying to figure out these earned insights by actually experimenting in the wild is to be very capital conservative until they feel like they've actually got lightning in a bottle, right? Because again, we have companies that run 10 different experiments before they have the one where they feel like, okay, now I actually want to put marketing dollars behind this. And when you just keep running experiments, that's unlikely to be what makes people want to give you more money, right? And so people, especially at like the A and beyond, they want to know exactly what they're investing into. And so that capital efficiency on the founder part helps the investors realize like, okay, this person, I still believe in him or her or them. And now, even if they did need another couple $100,000, I'm confident they will put it to good use. And so potentially I would give them an extension of the last round or what have you. I think from the investor side, it's about being clear that you're willing to be patient, right? I mean, I'm sure Jeff and Satya have this experience where a company hits it big and everyone's like, oh my God, how did I miss that? It's like, no, they've been struggling for 3 years and running these experiments in the background. And we were willing to keep extending them more capital and let them keep running the experiment because we knew they had a high bar before they'd say, I'm ready to launch. And then being very involved. And at least for us, we joke, we're your champion, but we're not your cheerleader, right? We're not here to just stroke your ego because again, we have a fiduciary duty, right? Those are LP dollars that you may be setting on fire if it's just about the fancy office and hiring out a team. And so we're just very clear in our communications. I know in the chat, someone had asked the question of how frequently should you be updating your investors? When we write a check at seed, we're talking to them every week, every 2 weeks, right? And part of that is because when you're the founder and you're building, you're in the weeds. And so you're busy, but you may not actually be making forward progress. And it's not that you need to have a dashboard and it's tracking certain things, because again, as you're experimenting, your North Star metrics may change, but having a sounding board that helps you realize whether, again, forward progress is being made is something that we think is really important.
And I want to talk a little bit about what you are showing to get from, you might still be pre-product market fit, but your seed money or your pre-seed money is running low. You're still in that experimentation phase. You want support from your existing investors, and you have to fundraise. And whether you're going to call it a seed extension, or you're going to call your last round of pre-seed and this round of seed, whatever it is, you need to show customer acquisition cost, or CAC. You need to show cohort analysis in your pitch deck, right? What are some of the other things that you need to show in order to present and explain to someone where your company is before maybe you figured out how you're going to explain and narrate these numbers?
We just made a seed 2 decision, which so I'll kind of use as a little bit of a mini case study. So when the financial markets crashed over the last few months, we looked at our portfolio and said, which are the companies that we invested in the seed where we wanted more allocation, where we have high conviction, where we'd like to put in more money, and now that the markets are down, maybe the founder would be open to extending the round or doing a seed 2. And one of those companies, which was a company that I led, was a company that was behind on its plan, but the reason for it being behind was clearly explainable and had little to do with product quality and more to do with operational and administrative complexity. It was a fintech that had some regulatory complexity to it. They had hit the key milestones to get through that delay. And more importantly, we looked at the behavior of their smaller pool of customers and saw the growth in usage, and in their case, GMV and loan volume increasing over time. And the founder had an even more compelling articulation of the market opportunity. His first go-to-market had failed, and he had adjusted his go-to-market approach. And the second go-to-market approach was seeing really good promise. And he had a clearer vision of an even bigger market opportunity. So instead of a TAM of, let's say, I'm making up the numbers, but let's say 1 billion, he had a clear articulation of a potential of a total available market of 5 billion. So we said, that's amazing. 6 months later, although he's behind on his plans, and even though go-to-market 1.0 was a failure, he's got a good go-to-market 2.0. The few customers that are using the product are using it really with enthusiasm and growing in their usage of it. And he's found a way to, because of his insights and his earned secret that he's developed by being in the market for the last 6 months, he's got his fingers on even greater set of opportunities. So those are the kinds of things that lead us, at least, to be excited about a seed 2, even if the numbers aren't obvious at the top line.
And there's by the way, there's a question in the chat, which we're going to get to. It's posed by Orville Black, and we're definitely going to talk about that. Thank you for sharing that, Orville. But I want to dive into this answer first. You were proactively looking to deploy more capital, not reactively responding to a request from a founder here, right? And is that because in Flybridge's view, you feel like you're buying the dip, or you feel like you've got to talk to your best portfolio companies now and give them some cash to survive a colder climate?
I don't think of it as buying the dip, because we don't get into market timing. We make investments for 10, 12, 15-year cycles. I think of it as there was an inability to get as much allocation as we wanted, because it was at a moment in time where there was a lot of heat around the company, and it was a very crowded round. Now that the founder may be more open to taking on more money and taking more dilution, in this case, than he had anticipated he might need to 6 months ago, we have the opportunity to double down. And Iris said it well, and I like what she described as her process, which I'm sure we could learn from. After 20 years of trying to figure out how to be good at the double down decisions, I think we're certainly not perfect at it, but those decisions turn out to be among your most important decisions. And so seeing the early signals and being proactive and being greedy, as she put it, is, I think, a really important part of being a good investor, as opposed to what you just said, Ed, which is when people are pulling us because they say, hey, I've missed every milestone and I'm running out of money sooner than I thought. and I'm in a defensive position, will you bail me out? That's a less appealing investment opportunity.
Anyone else want to weigh in on this topic that Jeff just addressed?
Yeah, I think this also touches on the earlier question around when you're building something that is going to require a lot of capital. I mean, I think all startup building and investing is about risk mitigation, right? Like when you start a company and you invest in a company, there at the earliest stages, there's infinite risk. And throughout the development of that company, it's all about like what risks are you eliminating or reducing so that somebody else will take the next bet on the company. And so when you're pre-product market fit, what we like to see are companies that have tested a number of hypotheses and have learned about what is or is not going to work, so that there are risks in the business that have been eliminated. And those risks can, be tied to the team, to narrowing the customer base, narrowing the use case. There's all kinds of risks in a company. And so if you can articulate that, you're not just wandering in the woods, but that you've identified the path or the set of potential paths that you could or should be on, that oftentimes justifies additional capital, because it shows that you're learning at a rate that suggests that you will eventually arrive at the answer of product market fit. And similarly, when you're building something that requires lots of capital, how do you break that into digestible chunks? Right. And so that each slug of capital that you get reduces risk towards the big opportunity. So as an example, we were early investors in a company called Boom Supersonic, which is building a supersonic jet, which is a 10-year exercise and a multi-$100 million project. Why were we willing to take a seed bet there? Because the team clearly articulated the steps it would take to put a supersonic jet into production, and was very clear what the initial capital would be used for that would help us see that they were on the right path towards that eventual vision. And again, whether you're building a supersonic jet or building a social network, pre-product market fit, if you can articulate the risks that you've reduced or addressed and the things that you've learned, that can suggest to an investor that this is a team to continue to bet on, despite the fact that there aren't clear signs of product market fit.
So I love that you invested in a supersonic jet. Amazing. I want to ask, and we're going to come back to how cold or warm is the market, but I want to come back to Orville Black's comment. And Orville, can you unmute yourself and share your comment question?
Yes. How everyone are you guys doing? My name is Orville Black, the CEO and founder of Relo. So the reason why I asked the question is based on some of us don't have or didn't get the opportunity to even experiment due to the fact of being in markets that take a lot of capital to do so. And you need the capital and also to experiment on large scale, but you also don't have the ability that investors don't give you the opportunity to even put in a pre-seed check into you and don't give you that time to even pivot. So in our case, we pivot into 2 different products within the time that we did, and all the investors turned us down. We even just came off a meeting with one of the investors that turned it down in December and asking us about the product. And we're convinced now that the product is a way better product, but we still have to then tell them more and more and more stuff and convince them even more on something that we know that we even have some form of attraction right now due to the demand for our product and our product being better. So I just wanted to address the fact of how can a founder even have the opportunity to experiment if they don't have the opportunity to experiment.
Before you answer that or speak to that, Ed, I actually cannot see the chat because Citi bans chat functions. I think I mentioned that. So if you wouldn't mind reading the question, just so I can have more context, and then happy to contribute wherever necessary here, let someone else do so.
Yeah. So Orville just said, if we don't get the money, or basically if we don't get the money, we can't experiment. How do we overcome that? And Orville, is that a relatively accurate summation of your comment?
So basically is from a standpoint of experimentation, we experiment on small cases so that we can then find product market fit or even have customer demand. But after you at a point, if you're in certain industries where we are in insurance, you need the money in order to then experiment on a larger scale to then say, okay, this product can work or not. So we experiment on smaller cases, but we didn't even get the opportunity to even take it to the next level. So I was saying prior to, we just came off a meeting with one of the investors that came back to us from December that had 5 conversations with us, even had us come all the way to New York to talk to them about our product. And then now asking us, okay, well, we want to see the algorithm working. We want to see this working, we want to see that working. And we're like, I thought the concept of investor is to find out the things that could work and not just say everything that can't work, to then give you an opportunity to stop you from giving an opportunity to try it out or even experiment to make it work. And every question that they asked us, we were able to answer it even now. And then also showing that we have a demand for our product and it's still hesitation to give us the opportunity to do so.
Thank you.
Orville, I would love to restate the question to make sure we all understand it in the way that you'd like us to. So is the thought here, you're finding that very few investors are willing to take a chance on founders like you while you're in the experimentation phase?
Correct.
Is that fair? You know, given I'm not the pre-seed investor on the panel, I'm happy to let the other 3 speak to this. I will say, for folks in your position, one thing to consider are accelerators and incubators. Those are generally very helpful when people are still very early on in their journeys. I would also say one thing to consider, and I say this as an investor who would say no to a pre-seed company or any company that was still very much in the experimentation phase. It's also important to really make sure that you're meeting with investors that invest in companies like yours, or whose theses or stage of investing are very much aligned with where you are in your entrepreneurial journey. I find that a lot of founders, particularly founders who are not necessarily in quote unquote tier 1 cities or areas where there's a heavy penetration of either venture capital investors or founders, that they'll just reach out to kind of any investor to see whether or not they'll invest. I think it's really important to make sure that you're reaching out to people who are investing at the earliest stages of entrepreneurs' journeys. Their thesis is aligned with whatever category you're building in, and also that you spread the net relatively wide. With that in mind, I will turn it over to Iris and Satya to speak to what signals you would like to see from someone like Orville before you decide whether or not it's worth investing while he's still in experimentation phase.
And I'm sorry, can I address what you just mentioned?
Sure, absolutely.
So I'm an alumni of Venture Crush, and Ed can speak to this as well, that I went through the program and went through the pod, and also with our previous company that we were doing. And one of the things too, with the companies that the investors that we talk to are in the insurance industry and are providing seed funds to what we're trying to do. It's just that for some reason, we're not getting the opportunity, or they're not taking the risk on us. We also are not all of our experiments is based on trial and error with talking to customers and building potential products in order to then experiment on that. So right now we already build out the product to even test it out, the algorithms and so forth, to try it out, to make sure, run data analysis to it to make sure it works. So what I'm saying is that for some founders like us, we have to come with everything already done, build, in order to even get an opportunity to do so. That's what I'm basically saying. Understood.
I think it's fair to pass it to a pre-seed investor to take the question and give them some feedback on this one.
And then we should probably move on to talk about market stuff and the other valley that we were going to get to. But I don't know if one of the other three would like to comment on this.
Well, I'd say that, it's always hard to hear no, and I think most founders hear no very often, but the key is to focus on the story that you want to tell, because ultimately investors at the early stages invest because they have an unwavering belief in the founder and in the opportunity. And so you've got to demonstrate not just like you've got a good plan now, but that you arrived at a plan at the plan based on important hypotheses that you tested and things that you learned that suggest that going forward, what you're going to do is the right answer. Not just that you have belief around it, but that there is evidence to suggest that what you want to do with additional capital is the correct path, and that what you do with that additional capital will then reduce risk further to allow you to raise more capital. So it's not a satisfying answer, because it can be hard to hear no over and over again, but the only way to get past all the no's is to get to one yes. And one yes just means convincing one investor that you've learned the right things, and that the plan you have going forward allows you to be in a position then to reduce risk further and attract additional capital. Because what an investor won't do is put more money into a company that they may have originally, supported the founder, but that capital leads to nowhere, right? Like the bridge to nowhere is the investor, is the thing that investors try to avoid. And so oftentimes we also have experiences where we love the founding team. They've learned some important lessons, but we don't believe that a small amount of capital is going to lead them to a point at which they can then attract additional capital. So, oftentimes there are other factors that go into a no, but you've just got to be cognizant that you are asking investors to take a bet on not just the promise of what you're doing, but on where you end up eventually, and that's going to be in a better position than where you are now, and that their capital now will then be rewarded by, further capital down the road. So challenging, but it's about the story that you tell.
Appreciate the answer. And just to close the loop there, I love that Steve Gilman, who is also a Venture Crush alum, and also a former Major League Baseball player and intelligence officer and serial founder with Exits, has offered to help. And Orville should just email him at steve@getrange.com. You can see that in the comments, unless you're Krista or working with Krista. So there is something that we should address, though, and this goes to a conversation that we had a couple of weeks that Krista and a couple of us had a couple of weeks ago about the unequal playing field and the level of access. And it cycles back to the comment I made earlier about, the difference between seed and pre-seed sometimes is just, what's your access to capital look like? We do not have a situation where founders of color, founders who are underrepresented are getting the same level of access. The numbers bear that out. It's part of the underpinning of why Jeff started Hack Diversity. It's part of the underpinnings of why Satya co-founded Screen Door, of why I co-founded First Close Partners, of why Krista is doing an impact fund at Citi. These are blatantly obvious statements at this point. And I would posit that when you are aware of the unequal access to capital, and you are looking at how do we get from pre-seed or seed to next round funding, and we're not quite at product market fit, and we have an underrepresented founder or an underrepresented founding team, is that going to disproportionately adversely impact them, that we have systemic bias to deal with as well? And how do you navigate that? How are you seeing people successfully navigate that?
I'm happy to start with that one. We've seen people unsuccessfully navigate that. One of the things that we've seen is one of the things I listened to earlier. Iris mentioned her firm is willing to invest in founders that have been struggling for years, and they're willing to give them more capital. I think you said 3 years or so, and then there's a tipping point. Typically, founders of color don't necessarily have that much time, and we've generally seen that in our own portfolio. We've had markdowns that are overwhelmingly founders of color versus founders that are not, unfortunately. So one of the things that we see is we'll certainly participate in investment. We rarely lead. The lead investors will see that founders are missing milestones. We'll say, we're not necessarily willing to follow on or further participate. We can't necessarily lead the round, and therefore the company kind of dies. One of the things that I think would probably be helpful to everyone on this call is, as Ed said, how does a founder generally get around that when they're not necessarily given the same time horizon? I would actually love, if possible, because I just happened to read the Squire case, which Jeff wrote, that addressed this to some degree. I'd love if we could start with Jeff's opinion on this or view on this.
Well, thanks, Krista. Look, a lot of people on this panel know a lot about this topic. I'll just throw a few thoughts out there. The Squire case, just to expand on that, Squire is a vertical SaaS company for barbershops. It was a company that was founded by two Black men in New York City, Dave and Song, who had to go through a lot of trials and tribulations to get to the point where they are today, where Tiger Global led their recent round at a $750 million valuation. It's an extraordinary company. And what those two individuals who I wrote this case about, and I've also, we created a fund, Flybridge created a fund called the Community Fund, which is focused on underrepresented founders, and Dave and Song are investment partners in that fund. And, a lot of it is about overcoming unconscious biases and conscious biases. And as a firm, one of the things we've tried to do is put systems in place to have a methodology for overcoming some of these unconscious and conscious biases, which involve having the perspectives of founders who are underrepresented, who might have a better connection to the founder, who might have a better way of judging their resilience, their grit, which are these maybe softer skills that it's harder to judge on paper if you just focus on pedigree versus really focus on acumen and skills and lived experience. And also, if you have the opportunity to think not just what this founder has achieved, but what this founder has achieved in the context of what resources and privileges they had available to them. If I meet a Harvard Business School team and they pitch me and they describe where they're at in their process, and then I meet a team from a historically Black college or university, and they pitch me and describe where they are in their process. If the teams are roughly equal, then I think, well, holy cow, the HBCU team has not had the same resources and privileges and networks inherently that the Harvard Business School team has had. They're probably more outliers in the context of their community and in the context of what resources and opportunities they had available to them. Imagine what they'll achieve 2 years from now, 4 years from now, 6 years from now. So there are a number of rubrics and approaches that you can take. But one thing that Krista is pointing to, and this is what one of the key messages of the Squire case, is that for a lot of underrepresented founders, the hardest capital is the first stage, the first check, the first piece of credibility. When you achieve that first bit of credibility, you begin to build social proof. But how do you come as an outsider and get that first piece of credibility and get that first social proof? In the case of the Squire founders, it was having one of the WeWork founders write an angel check. As soon as that happened, it immediately created an aura of credibility around these two very, at the time, unknown guys who were outside of the ecosystem. So a lot more to say, but I'll stop there.
I'll say one of the initiatives that I've been pretty passionate about internally, and also focusing on underrepresented founders and GPs being inside of a large organization. 50% of my job is just advocating for new ways for us to think about investing in founders. So I spend a lot of time thinking about this. But one of the things that we spend a lot of time on now is platform development and something we call post-investment initiatives, which is finding ways to better support our founders once we write checks in. I know a lot of firms have been doing this for quite some time. There are firms that are very well known for it, but generally investors who spend a lot of time on portfolio development, platform development, et cetera, do a slightly better job at helping the companies in their portfolios get over that valley of death. I don't know if anyone else has found that as well. I would also say one of the things to consider for underrepresented founders, and this is also one of the reasons why quite a few of us on this call invest in underrepresented GPs, is it's very true statistically that when you have an investor who has a shared identity, that person is also willing to take more chances on you than someone who does not. That has also been helpful in helping founders kind of get over that valley, that we're at least finding that. I'm not sure if anyone else has seen that as well.
I mean, I suspect it's more anecdotal than data driven, but at Floodgate, 2 of the 4 GPs are women. And so we have lots of female founders in our deal flow. And there was a period of 6 months where every deal we led was actually with a female CEO. I think part of it is from the founder perspective, being able to get access to the GPs or just having them within their network and being able to get that warm intro, which has obviously been problematic, but historically the way to be able to get your foot in the door for a VC meeting.
And I think I think it's a really complicated issue. And we often talk about vouching in the context of venture. And I don't think that it is the first dollars that are the hardest. I think it is the first dollars that are the hardest. And then for underrepresented founders, it is the second dollars, and then the third dollars, and then the fourth dollars. I think it continues to be hard. And this is definitely something that we've talked about at prior Venture Crush events. There is also something really important about vouching in a system that has bias built into it. And there's a historical concept, right? And the concept is, this is a quote about certain people who are, quote, obliged to obtain vouchers from market participants and have found it virtually impossible to comply in areas where almost none of those people are incumbent market participants. Now, I changed the words from registered voters to market participants, and the vouchers in that situation, this was Chief Justice Earl Warren in South Carolina versus Katzenbach from 1966. This is a civil rights litigation about the suppression of the Black vote. And it's really hard to have Black citizens who want to register to vote get vouchers from registered voters in towns where there are no Black registered voters. And so there's an extent to which, if you have a venture ecosystem that lacks capital in the hands of investors who look like the founders we're talking about, investors who share a lived experience with the founders we're talking about, as we walk through a world in which we can have someone in Buffalo literally hunt down people in a store that he knows is going to be a predominantly Black store and hunt them down solely because they are Black. There's a range of systemic problem. There's a range of systemic bias, but we have to be really thoughtful about how we can overcome this vouching from market incumbents and how we can spot talent without outsourcing it to the admissions offices at Ivy League schools. And so I agree very much with Jeff's comment and with Krista's comment. And we see that not only are funds run by underrepresented folks more likely to have diversified networks where the latter is being extended, but founders are also more likely to take comfort in applying to those funds for capital because there will be a different level of understanding that arises from lived experience. And it's something that I think we should be talking about, and a concern that I have, I don't want to speak for Krista, but I know this is something we've discussed, is that in a down market, we're going to lose focus on that. And in a period where a company is struggling with product market fit, we're going to lose some focus on that. And you're not going to have a situation like Fast. And I don't mean to pick on Fast. I don't know enough about that situation, but 600,000 of annual recurring revenue and $1 billion valuation. I'd like to see some Black-led companies get overfunded. I'd like to see some Latinx-led companies get overfunded, some LGBTQ-led companies get overfunded, some women-led companies get overfunded to that extent, and burn through those dollars, because it will at least give us a proof point that there's a little more equality. And I feel like we demand much, much more. And we just need to be mindful of that, because it's also, there's also a financial opportunity, because they are often folks who have had to achieve so much more to get the funding, that it should be easier to bet on outliers, and it's not.
I just have one quick comment from a tactical perspective. We understand that there's bias. I do think the onus is largely on investors, not necessarily founders, to figure out how we can give people more benefits of the doubt if they happen to be underrepresented. But one of the things that I would like to mention is, certainly as a founder, I would love to see for people ask for more feedback. And I know that sounds like a very high level recommendation, but I do find that when people do, it's generally incredibly valuable. And it also forces investors to think about why we're making the decisions that we're making. One other thing that I really love seeing, I actually led our investment in Precursor Ventures Fund 4. We're currently an LP. I think most people on this call are very familiar with Charles Hudson. And he has several very high performing Black-run companies in his portfolio. One of the things that he does really well is builds community around the founders in his portfolio. So more mature founders are able to connect with and mentor founders that are earlier in their journey. And those types of connections are what help and really buoy founders who are just trying to figure out product market fit, just trying to figure out fundraising. It helps them really understand how to connect with other investors that will potentially lead their Series A, how to think about transitioning from a founder-led sales process to actually building out a sales team, et cetera. So I think that's a model that hopefully more emerging fund managers will certainly adopt. But I think it would be helpful if all investors generally adopted that model as well. I found it to be incredibly helpful for the founders in Charles's portfolio. And I say that as someone who's done the diligence and spoken to them one-on-one to really see this in real time.
So as we move toward wrapping, I want to hear how cold the market has gotten, because we don't typically get the opportunity to hear from this much success and experience as a market is changing before our eyes. So maybe Jeff, you want to go first, and then whoever wants to go second can go second.
Sure.
And I will also mention that I am a proud investor in Precursor, and I know that Charles is also involved in Screen Door with Satya, and Charles is amazing.
So the market right now is people are definitely on their heels, but what folks need to know is that venture capital funds are committed capital, and a ton of capital has been raised by new funds at every stage. The ecosystem right now is flush with cash. And so although in other downturns you would see maybe more severe contractions, I'm not sure we're going to see the cliff falling off as we saw in 2009 and as we saw in 2000. I think we're going to see a pullback, a slowing down, elongated diligence cycles. One of the running jokes in our industry was that the first step of due diligence was the board meeting post-closing during the time of crazy heyday. I think now people are going to actually stop and do due diligence, and they're going to vet founders and vet business plans and take the time to get to know each other as opposed to being so transactional. We've been all operating at, speed 11, and I think it's going to dial down to 7 or 8, but it's not going to 0. People still have a ton of money, and people are still looking for investment opportunities in our world, in the world of early stage, with 10, 12, 15-year horizons. So these permutations and cycles don't really affect how early stage venture investors think and approach opportunities.
Yeah, from where I sit, I feel like there was more sense of panic actually in March of 2020, right back when we were sheltering in place, and it was becoming clear we're in the midst of a global pandemic and the stock market fell off. And I think part of it is the recency bias for how quickly the stock market was on a tear after that, where we were kind of only down for maybe 2 to 3 weeks. And so many funds, so many multi-stage firms had raised billions of dollars earlier in that year. And so to Jeff's point about there was plenty of capital, and that's happened again, even in 2022, oftentimes with the same funds already having been back in market. And so from what I've seen, it's more the sense of urgency. Again, the preemptive term sheets are less likely to happen. People are willing to take their time. But I don't think that there's that sense of panic that we had of the unknown from 2 years ago. I think it is founders recognize that the fundraising environment will be much more challenging just because people don't necessarily feel, again, the sense of urgency to deploy that capital quickly.
Satya, Krista, want to weigh in?
Go ahead, Satya.
Oh, go ahead, please.
So we've kind of always had this forcing function that has prevented us from investing in companies that we felt were too richly valued even before the downturn. And that's largely, again, I mentioned this early on the call, but we have control teams. So that's risk, compliance, legal, et cetera. That prevents us from moving very quickly and hopping into a round that's just too rich for our appetite. So for us, nothing has changed. With that in mind, we are seeing a more difficult fundraising environment. We're still investing. I mentioned this on Twitter, actually, sometime last week. We actually closed 3 investments within a 2-week period. 2 of them were follow-on rounds in a company, one in a company called Jetty, another in a company called Daylight. So I will say, yes, challenging fundraising environment, slight overreaction. We're not necessarily panicked. I don't know that founders should be, but I'll turn it over to Satya to hear his views as well.
And Satya, are you seeing term sheets get pulled?
We have heard of term sheets being pulled outside of the portfolio, and but we haven't experienced that, fortunately. But yes, we have seen that, and the reason for that, I think, is really what's going on in the market is, as Jeff and Iris pointed out, I think people are still looking to allocate capital, but right now, given that we're just at the beginnings of all this change, investors don't know how to price opportunities. And you're seeing them pull term sheets based on not knowing whether the multiple compression we've seen is permanent or temporary. And I think you're going to see that kind of play itself out over the next few months and kind of establish a new normal, certainly for the next 12, 18, 24 months. And so at that point, I think given the amount of capital in the market and the fact that investors need to allocate that capital, you will see investments getting made. I think you're seeing investments getting made now, but the valuations are certainly different than 6, 12 months ago. And you're also seeing that the bar for new investments is a little bit higher than what it was earlier as well. But if you're a founder, I'd say, take the capital that you have and make it last a little bit longer, because you probably have more that you need to prove. And assume that the next capital that you raise will be more expensive than it has been in the past. So you really want to make sure that you're accomplishing as much as possible, reducing as much risk as possible between now and the next financing, so that that multiple compression doesn't just mean tons more dilution for you, and hence lower ownership for you as you build the business.
Thank you very much, Satya. And thank you to all of our panelists. I think that there will be a premium on at least having someone around the table who has been through several different downturns. because understanding the differences between the downturns and how things play out, and how corporates, and Krista did a good job of highlighting some of those differences between corporates and, or strategics and pure play venture, how these things play out. I think experience will be helpful and valuable. So I want to thank all of you for sticking with us for the full 2 hours. I also want to thank the Venture Crush team. Definitely want your feedback. We'll do a survey, and also we'll provide a recording of this and Jeff's terrific PowerPoint. Jeff, that was great. Really appreciate it. Do reach out to Krista for Black Women in Crypto, and which is a great initiative. And we greatly look forward to seeing all of you soon. Take good care and say gay. Thanks, everyone.